How to Lose Your Money Investing in Property, brought to you by RFI.
Being in this industry, we get to see lots of different people making money and losing money through property investment. It's an unfortunate part of the job. A lot of people come into property investing to build their wealth, build passive income. They've got big dreams about retiring early and making their lives a little bit better through buying rental properties. But what we often see is because people are not quite educated, or they rush decisions, they actually can lose money. So what we're going to have a quick look at is how to lose money in property investment. And the reason that we do this is one of the great lessons we get from Charlie Munger, who is Warren Buffett's business partner, is to look at a problem in a different way. The best way sometimes is to invert the question of, say, how do I make money in property investment, is how do I lose money in property investment? And then after we understand the ways to lose money, to do the opposite, or to make sure at least we avoid the habits and the strategies that lead you to lose money in property investment. So I think that probably one of the most defining characteristics we see that when people are losing money through property investment is they're learning from their own mistakes. So examples of this are going out and shopping around for a rental property without talking to any friends or family that have knowledge in property investment, without getting outside advice from mortgage advisors or potential property coaches, without reading books, without listening to podcasts. They just get this idea, hey, I want to own a rental property. They go out and buy one of the first ones they look at, and then they come to regret that decision for a variety of different reasons. Maybe the property is leaky, maybe it's a plaster property, maybe it's a leasehold, maybe the mistake that you made was actually trusting the wrong person. So what point that I'm trying to make is you don't actually have to learn from your own mistakes in the property investment game. There's heaps of books out there with awesome case studies. Some of them are profiled on our website. There's lots of property associations out there that are relatively cheap. Most of them are even free. There's the property investment chat group on Facebook that you can post your thoughts and questions in. Working with mortgage advisor like iRefi, who help heaps of property investors, usually is a free service. So you can talk to a mortgage advisor who helps heaps of different property investors, and you can relay ideas off them. And the point that I'm getting is that if you try to make too many decisions on your property investing future, and you haven't read up and done all of the homework you need to do, or you should do before making these big decisions, it is quite likely that over the life cycle of your property buying, that you will make mistakes. And sometimes these mistakes are tax mistakes. Sometimes you don't even know about the mistakes until 5 or 10 years later. And there's no real way to guarantee you don't make any mistakes, but what we're trying to do is minimize them. So you don't have to learn from your own mistakes. Don't let pride get the better of you. Talk to lots of different people, and that way you'll be able to avoid making the mistakes. Number 2 on the mistakes that property investors make is buying just for capital gains or just for cash flow. So it's a real common misconception, especially amongst New Zealand investors, that when you're buying a rental property, often you have to choose between high yield or buying in a high growth area that is more likely to have the higher capital gains. And on the either side of that equation, you're making a sacrifice. So when you are buying for high cash flow, you're not going to get the good capital gains, like buying, people talk about buying in Invercargill because it's really good yield, versus say buying in Mount Wellington when it's incredibly priced high in terms of the yield side of things, and accepting a relatively low yield because you really are relying on the capital gains. So one of the lessons that we have especially been able to be privileged to be a part of is seeing lots of different property investors, and the most successful ones we've seen are buying properties that have both capital gains and cash flow built into the equation, and they're not leaving too many things up to chance. So parallel. Most of the mum and dad property investors in Auckland have been capital gains investors. If you take someone like Graham Fowler, he's more of a cash flow based investor. He's using 20-year mortgages with P&I terms, and he's getting the instant equity by buying well, and he's relying on the yield. But if you take a very close look at his portfolio, which he is happy to share online, you will see that he is actually getting capital gains, and a lot of the wealth building that he's had is as a result of the capital gains. So whether he would be free to admit it or not, and along with many other successful property investors, the reason that they've been able to accumulate so much wealth over that property investment tenure they've had is because of the combination. And you actually can find the properties if you know where to look, and you actually can create those opportunities. And that's why we don't recommend that people just think, hey, I need to buy for cash flow, or I'm only focused on buying for capital gains. You actually can buy for both. One of the hacks is actually to buy for cash flow, capital gains, and using capital improvement, the renovations. That's how you're able to increase your return on cash invested, and you're able to get the yield from the property that will enable you to recycle equity out, get the cash flow you need, and because you are buying an undervalued property, preferably in a better area than Invercargill, no disrespect, hopefully something a bit closer to Auckland main city centres, maybe Hamilton, or some of the bigger cities, then you actually you can't go to the bank on capital gains, but you can, based on history, assume that over the 7 to 10 year property cycle that values will improve. So don't just buy for one or the other. Think, using a combination strategy, how can I get the best of both worlds? Obviously there will be trade-offs, but don't necessarily think you have to buy central city apartments just to get cash flow, or properties in Invercargill. You can actually work towards both strategies working in combination. So number 3, too many ideas and too many plans and not enough action. So one of the most frustrating things working with property investors is everybody comes to us saying, oh yeah, I think I want to buy 10 rentals, and then you call them the next year and they still got the same plan or same idea. They're not taking any action, because lots of people think, oh yep, I'm going to be a property trader, I'm going to do some renos, going to buy some cash flow properties, some capital gains properties, do some joint ventures, do some subdivision. They talk a big game. They've got lots of ideas, but there's not enough execution. So you got to be realistic with yourself, and this is including if you've made mistakes and lost money. Is what are you good at? Are you a subdivision expert, or do you think you could be? If not, then that's not a good strategy for you. Are you good with your hands? You're like handy around the house? Because if you're not, then a renovation strategy in terms of DIY might not be the right strategy for you. So there's no point of buying a house that needs to be done up, and the only way the numbers work is if you do it yourself, because you're going to lose a lot of money, you probably spend way more than you thought, and you're going to make lots of mistakes on the way. So you've got to pick the strategy that works, that is going to work best for you. And having 5 to 10 different property investment ideas is great, but focusing on 1, maybe 2 at max is going to be, for most property investors, the correct strategy. What I've seen, one of the most successful clients we've worked with is the family bought a bunch of different properties over the last 15-20 years, and they would always turn these properties into multi-income, so 2 houses on the same property. And what that did is they buy at or below market value, do capital improvement, improves the cash flow, because those properties turn from 1 into 2. They're getting capital gains at double the speed, they're getting cash flow, and they're getting new equity from the new property, and they just keep recycling. And now what they've got to a point is the cash flow is so strong, now they're building and buying commercial properties, and they've stopped doing the multi-income because they feel, based on the market timing, that's not the right thing to be focusing on. So they don't try and do all of the different strategies at once. They pick what they knew they were good at, what they've seen success in, and they focus on that. So there's no point in reading 100 property investment books if you've already got really good ideas. You got to pick the one that's going to work, execute, take action, and then while you're waiting for the capital gains and the cash flow to build up again, then maybe you can do some more research. This one's pretty self-explanatory. If you want to create wealth through property, and you've made mistakes, or you've lost money, or maybe you didn't make the money you're thinking or hope to make, don't get discouraged. Property is a very forgiving game. You can build up more equity, you can save up more money, and you can get back into that property investing game. So don't let one or two bad deals get you down and make you give up. You're not going to make, unlikely, heaps more money on Bitcoin, and the share market does take a long time to compound. So unless you're a business owner and you're really awesome with business and you're going to make money through that, property is probably still the way that you can build up and create your wealth. So don't give up. If you've got no money because you've lost it all on property deals, but you've got the knowledge, then you should be able to go to your friends and family and create joint ventures, maybe do some property flips, create some equity that way, get back on your feet within a relatively short amount of time, and don't be discouraged if your first one or two deals didn't go the way you had hoped. So we're getting more into the detailed specifics of property investment advice. The mistakes that people make when they build up a portfolio is, if you pay down your mortgages too quickly and don't build up an offset or a cash account or a revolving credit account, sometimes that your equity can get trapped and you actually can't free it up to buy more properties. And when you're dealing direct, especially with the bank or working with a mortgage advisor that maybe doesn't specialize in property investment, as you get a little bit older and maybe you're not thinking about property investment as frequently, and then you get this idea or you see a deal, what you might find is your equity is not usable. You can't free it up, and you get to this situation where if you want to take advantage of this next opportunity, you have to sell a property to buy the next one, which is actually reducing your ability. You're selling a cash producing asset essentially at a discount to the future value, which defeats the whole point of accumulating assets. So we're not going to dive into the details now. I do cover it a little bit in the blog, but what you really want to make sure is that if you do want to keep buying properties, you think there's a chance, get an assessment on how to free up equity. And this is why people like using offset and revolving credit accounts, is that cash is actually ready to go. If you just keep paying off your mortgages, you're still going to have to apply for that lending, which means statements, income proof, all sorts of things, hoops you got to jump through. And basically, if you can, you want to get to a stage where you don't have to say to the bank, hey, can I have this money for the deposit? It's actually just there, ready to go. And some people actually can build up enough that they don't even need new mortgages. They can settle the property, even if need be, with a non-bank lender, and then refinance back to the main bank. And property investment, if you're getting really into the thick of it and you're looking at deals regularly, sometimes the way to secure the biggest discount is to buy and settle quickly. And if your bank can't do it, you actually realistically might be looking at non-bank deals. You've really got to make sure that your equity for deposit is ready to go. And this kind of dovetails into what cross security is. Cross security is really good for the bank. It's not necessarily so good for you. So this is when your property portfolio is all tied together, multiple securities supporting a whole bunch of lending. Basically, the way you want to consider doing it is separating your properties across different banks. And this allows you to be more ready If you sell a property to keep the proceeds, or you want to keep borrowing to buy more properties, it will actually probably in most cases give you a higher borrowing power. You always can cross-secure things again later on to maximize your borrowing power, but what you want to do, Brandon calls it game theory, is give yourself as many options and minimize chance of loss. So this is why if you're not already working with a mortgage advisor, and consider working with multiple banks, assessing whether you should separate securities. You want to get rid of this cross security and free up some equity. That's one of the most frustrating things is when we see property investors, they want to keep buying and based on the numbers they can, but things are trapped, and that can be a bit disheartening when things wasn't planned out properly. Hotspots. So buying property in hotspots, this is one of my pet peeves. This is why I get so frustrated when I see people do this, and I feel really bad that real estate agents can take advantage of a situation like this. So hotspots is places like Tauranga right now, Wellington in some respects. It's when the growth has been insane. There's high demand to buy, low-ish supply in the current time, and so the market value of properties is just climbing. This is a really bad time to buy in that place. So what we've seen a lot of people do is sell a property, say in Mount Wellington, where capital gains over the next 20 years is likely to be really good. It's a high demand area. Auckland is a hustle and bustle city, and they might sell that property for because Auckland has been flat, $1 million. Now, realistically, if they waited, or if it was true over the long term reversion to the mean type of value, they probably could have, if they waited just a little bit, sold that property instead of for $1 million, they sold it for 1.1. So by selling in Auckland, they're losing 100 grand. Now, when they go down to Tauranga and they find the house they want to live in, it might be, say, 700 grand. And what they're actually doing is, based on the true long-term market value of that property, they're paying 700 grand. They think, oh, it's not a bad deal. It's actually only worth 600 grand. There's a few negative aspects about buying in Tauranga. I love the place, but in terms of just the metrics, it's not as good as Auckland. So what this hypothetical family, and it happens all the time, is doing is losing 100 grand on the sale in Mount Wellington, paying too much in Tauranga, and essentially, without even realizing it, losing $200,000. And that's just a part of the equation, because the long-term effect of doing this is even more negative than that. And this is actually happening within cities. So the new builds in Millwater and Hobsonville, people are selling their properties with a bit more land in better areas in terms of capital growth potential, and they're going and moving to these new build houses that, they have the warranty, but they're much smaller in terms of land size, and they're in a little bit further out areas, so capital gains probably is not going to be as good. And because of the market, they're paying full development costs. The builder's not going to discount that much, and the real estate agent that is helping them is not able to get proper market value over the long term for their current property. So they're underselling by 100 grand and overpaying by 100 grand, and they're, without even realizing it, losing 200 grand. So just be careful about buying in hotspots, because you can get the excitement and let that get the better of you, but as long as you're aware that it's actually costing you a lot more than you realize. This kind of builds on the next big mistake I see people making is trusting commissioned advisors. So when there's a big commission on a property sale involved, this can color people's decision making and the influence they have. So you do see some mortgage brokers pushing their clients into specific properties, and this is because they're getting commission on the sale of that property. And we see a lot of this with the pretty shit, excuse my French, apartments that people are getting pushed into, and the new builds that definitely I wouldn't want to own in terms of the size and the future scope for capital gains. So you can get tricked into buying properties that I wouldn't be advising my family to buy them for the strong reasons that I'm not going to outline right now, because these real estate agents and these property developers can be very convincing. The printing that they supply, the numbers that they can supply, you can make any property look good on paper in terms of deductions and depreciations and capital gains and yield. You can make them all look good. But what you've got to assess is the opportunity cost and what can your dollar actually buy elsewhere. And so in terms of trusting real estate agents, most of them are very, they're honest, they're hardworking, but whether they realize it or not, their influence and impact on your buying decision making might always not be what's best for you. So you really do have to be careful when you're trusting people that are commissioned. And that does include mortgage brokers, and that was one of the reasons, even though sometimes it can be hard, is we pay all of our staff a base salary, because otherwise they're just going to be like every other broker and every other banker that is influenced and pressured by bonus targets, or by having to pay their rent or their mortgage. And I've seen it even this week, a mortgage broker that helped a friend of mine a year ago into their first home, she was saying to my friend, if you refinance, I'm going to lose my commission, and really trying to guilt trip my friend to not refinance, because even though there's a huge financial savings for my friend, the broker was going to lose their commission. So the salespeople are not putting your needs first, is what I'm trying to say. So just be careful. One of the mistakes that we see often, and sometimes it's unavoidable, is people are using their equity, their home equity, as a piggy bank. They're seeing that their property has gone up by $50,000 or $100,000 in value, and thinking, I need a trip to Fiji, I need to buy a new car, we need some new furniture around the house, actually I already have some debt, let's consolidate it. And by all means, you can use your money in any way that you want. But what we've seen is a lot of people have had the same size mortgage for 10 or 15 or even 20 years. And so if you use your home as a piggy bank, it's going to be very hard for you to build wealth over the long term. If you buy crap instead of cash producing assets, then you really have only yourself to blame about the wealth building. If you haven't built up the passive income that you want, if you haven't built up the property portfolio you want, maybe it's time to sell some of the stuff that you've bought, even if it's at a loss, get that cash ready to go and start looking at buying another property. Because the TV that you buy or the car that you buy is not going to be there when you retire. And you'll be thinking, well, I had a good life, I enjoyed my things, but you won't be able to enjoy all of the things. So delay gratification today so that you can enjoy even more in the latter years. And that's all I'm going to say about that.
Thanks for watching. We hope this saves you a lot of money. Check out irfi.co.nz to keep learning and become a master of property investment and mortgages.